In the ruthless calculus of Silicon Valley, you either innovate or you die. But there is a third option, a secret path reserved for the titans who have forgotten how to build. You simply buy the people who are trying to kill you. For decades, this was the unwritten law of the tech industry, a strategy executed with surgical precision by the giants to maintain their iron grip on the market. But in 2004, something unprecedented happened. A giant reached for its wallet to silence a competitor, only to have the government slap its hand away. But the government didn't just stop the deal. They inadvertently triggered a contractual clause that forced the giant to hand over $1 billion cash to the very enemy they were trying to destroy. This isn't just a story about software. It is a case study in corporate hubris. It is the story of how Adobe, the undisputed king of the creative world, found itself funding its own executioner. The company that once revolutionized digital art had become a landlord, trapping creatives in a labyrinth of subscriptions and hidden fees. They thought they could buy their way out of obsolescence. Instead, they armed their rival with a war chest so large it fundamentally altered the balance of power in the design world. The green owl of language learning might demand your time, but the red A of Adobe demands your soul and, more importantly, your credit card information. But to understand how we arrived at this billion-dollar blunder, we have to understand how a company built on creativity became the face of corporate stagnation. The architect of monopoly. To understand the present, we must dissect the past. Adobe's dominance wasn't an accident. It was a carefully engineered architecture of control that began long before the cloud. If you rewind to the mid-90s, the digital landscape was the Wild West, a chaotic frontier of competing tools and formats. In 1994, a company called Aldus possessed a piece of software known as freehand. It was lighter, faster, and, in the eyes of many professional illustrators, vastly superior to Adobe's own Illustrator. Logic dictates that competition breeds excellence, forcing both companies to improve. Adobe chose a different logic. They initiated a merger with Aldus. The Federal Trade Commission, even back then, smelled a rat. They forced Adobe to divest freehand to keep the market competitive, a temporary hurdle that Adobe cleared with the patience of a predator. 10 years later, Adobe acquired Macromedia, the then parent company of freehand. The trap finally snapped shut. With the competition owned, development on freehand stalled, support vanished, and thousands of users were herded forcefully into the Adobe ecosystem. It was a masterclass in the catch-and-kill strategy. By eliminating the alternative, you don't just gain market share, you gain leverage. This monopoly allowed Adobe to fundamentally change the relationship between toolmaker and artist. For decades, you bought software inside a box. You paid a few $100s, you owned the disk, and it was yours forever. If Adobe released a bad update, you simply didn't buy it. You held the power of the purse. But in 2013, Adobe realized that selling products was inefficient compared to renting them. They launched the Creative Cloud, a shift that was marketed as a way to deliver constant updates, but in reality was a shift to digital feudalism. The transition was brutal. Overnight, the concept of ownership evaporated. You were no longer a customer buying a tool. You were a tenant renting a workspace. If you stopped paying, you didn't just lose access to future updates. You lost the ability to open your own files. Your past work was held hostage by your future payments. The revenue charts went vertical. Wall Street applauded the brilliance of the recurring revenue model, pushing Adobe's stock to the stratosphere. But while the shareholders celebrated, the resentment in the creative community began to fester. The Velvet Trap. Monopolies do not crumble because of a single bad decision. They rot from the inside out because they stop fearing their customers. With no viable alternative to jump to, Adobe began to tighten the screws. The pricing models became increasingly complex, a labyrinth of tiers designed to extract the maximum value from every user segment. But the true hostility of the system was hidden in the exit strategy. Try to leave Adobe, and you encounter the dark pattern to end all dark patterns. They offer a free trial that seamlessly rolls into a yearly contract paid monthly. It looks like a monthly subscription, it feels like a monthly subscription, but the legal fine print defines it as a debt. If a user tries to cancel after the 14th day, they are hit with an early termination fee. This isn't a small administrative charge. It is a lump sum demanding 50% of the remaining contract value. Imagine ordering a coffee, drinking half of it, deciding you don't like it, and the barista charges you for 50 more coffees as a penalty for leaving the shop. It sounds absurd in the physical world, yet this became the standard operating procedure for the primary tool provider of the global creative industry. Users who thought they were signing up for a $40 experiment found themselves slapped with bills for hundreds of dollars just to stop using the service. This predatory retention strategy worked because it had to work. There was nowhere else to go. If you were a video editor, you needed Premiere. If you were a designer, you needed Photoshop and Illustrator. The industry standard file formats were proprietary. The ecosystem was a walled garden with razor wire on the top. But while Adobe was busy building higher walls to keep people in, they failed to notice that the ground beneath them was shifting. They were building tools for a solitary genius sitting at a powerful workstation. But the internet was becoming multiplayer. The browser rebellion. While Adobe was optimizing its extraction algorithms, a small team led by Dylan Field was asking a fundamental question. Why is design still a single-player game? In the age of Google Docs and real-time collaboration, sending distinct file versions back and forth via email felt archaic. Naming files final version v3 real final.psd was a joke that everyone laughed at, but it represented a massive inefficiency in the global economy. Enter Figma. Launched in 2016, it was everything Adobe was not. It didn't require a high-end computer. It ran in a browser. It didn't require you to save files. Everything was in the cloud. But the killer feature was the cursor. You could see your teammates moving across the canvas in real time. It turned the solitary act of design into a collaborative hum. To the old guard at Adobe, this looked like a toy. How could a browser-based tool possibly compete with the raw power of a native application that had 30 years of code behind it? This underestimation is the classic innovator's dilemma. Adobe was paralyzed by its own legacy. They couldn't simply rewrite millions of lines of C++ code to work in a web browser overnight. They were weighed down by the very assets that made them rich. Figma, unburdened by the past, built on modern web technologies like WebGL. They didn't just build a better tool, they built a better workflow. The shift was seismic. Product managers, developers, and copywriters, people who never touched Illustrator, were suddenly inside the design files, leaving comments and tweaking text. Figma didn't just steal Adobe's customers. They expanded the market to people Adobe never even considered. The toy started winning contracts with Microsoft, Uber, and Airbnb. By the time Adobe woke up to the threat, it was too late to compete on merit. The network effects of Figma were already locked in. So Adobe did what they had always done. They opened the checkbook. The $20 billion panic. In September 2022, the news broke. Adobe announced it would acquire Figma for $20 billion. The price tag was staggering. It was double what Figma was valued at just a year prior, and represented a multiple of revenue that defied traditional financial gravity. Wall Street hated it. Adobe's stock crashed, wiping out billions in market value in a single day. Investors saw it as a desperate admission that Adobe could no longer innovate. But for Adobe, the math was simple. Figma wasn't just a competitor, it was an existential threat. If Figma continued to grow, it would eventually eat the entire creative cloud. $20 billion was a steep price, but the cost of irrelevance was higher. It was the ultimate kill zone play. Buy the challenger before they become the champion. The plan was to absorb Figma, integrate its technology, and likely slow its pace to protect the cash cow of the legacy desktop apps. The creative community panicked. The internet was flooded with memes of the Figma logo dissolving into dust, a grim homage to the fate of freehand. Users prepared for the worst: stagnating features, login requirements, and the inevitable integration of the dreaded cancellation fees. It seemed like the cycle was closing again. The giant would eat the startup, prices would go up, and innovation would go down. It was the natural order of the tech ecosystem. But the world of 2023 was different from the world of 2005. The regulatory winds had shifted. In Washington, London, and Brussels, a new philosophy of antitrust was taking hold. Regulators were no longer looking just at consumer prices, they were looking at innovation. They argued that allowing a monopoly to buy its only serious threat was bad for the future of technology. The U.S. Department of Justice, led by aggressive enforcers, prepared a lawsuit. The UK's Competition and Markets Authority blocked the path. The European Union signaled a red light. Adobe fought hard. They argued that Figma and Adobe were in different markets. They claimed that Adobe was about creative work and Figma was about product design. It was a flimsy semantic argument that convinced no one. After months of wrangling, looking at the insurmountable wall of regulatory opposition, Adobe blinked. In December 2023, the deal was officially dead. The billion-dollar injection. When a merger agreement is signed, there is usually a clause known as a reverse termination fee. It is designed to protect the smaller company. If the buyer gets cold feet, or if they fail to secure regulatory approval, they have to pay a penalty for wasting the target's time and disrupting their business. In the Adobe Figma deal, that fee was set at $1 billion. When the deal collapsed, Adobe had to wire $1 billion of pure cash to Figma. To put that number in perspective, Figma had raised roughly $330 million in venture capital funding in its entire history up to that point. In a single transaction, Adobe handed their biggest competitor 3 times their lifetime funding. It was an infusion of capital with zero dilution. No shares were sold, no board seats were given up. Just $1 billion to say, sorry, we couldn't buy you. This was the moment the timeline fractured. Usually, when a startup fails to be acquired, they struggle. Employee morale tanks, the stock options seem worthless, and the momentum dies. But the billion-dollar breakup fee had the opposite effect. It acted as a massive validation. It proved that Figma was so dangerous that Adobe was willing to pay $20 billion to stop them. And now Figma had a war chest that rivaled public companies. They didn't buy yachts. They doubled down. Figma expanded its engineering team. They launched Dev Mode, bridging the gap between design and code even further. They pushed into AI. They began to look less like a design tool and more like an operating system for product development. The $1 billion allowed them to weather the economic downturn that crushed other SaaS companies. While others were laying off staff, Figma was building. The Double Jeopardy. While Figma was counting Adobe's money, Adobe was facing a reckoning on a second front. The anger over their subscription practices had finally reached the halls of power. The Federal Trade Commission, led by Lina Khan, filed a lawsuit against Adobe. But they didn't just sue the corporate entity. In a rare and aggressive move, they named specific executives in the complaint. The lawsuit alleged that Adobe had designed a labyrinthine process to prevent cancellation. It claimed that the early termination fee was not clearly disclosed, hiding in the fine print and popping up like a jack-in-the-box only when a user tried to leave. The government had access to internal communications, evidence suggesting that Adobe knew exactly how confusing the process was, and kept it that way because it reduced churn. This was a public relations nightmare. For years, creatives had complained about being trapped in the Creative Cloud. Now, the United States government was validating those complaints in federal court. The image of Adobe shifted from the benevolent provider of Photoshop to a digital slumlord relying on entrapment to boost quarterly earnings. To make matters worse, Adobe's clumsy attempt to integrate AI sparked another firestorm. They updated their terms of service with vague language that seemed to grant them the right to access and use user content to train their models. For professionals working under non-disclosure agreements, film editors, concept artists, product designers, this was a deal breaker. The backlash was instantaneous and ferocious. Users threatened mass cancellations. Adobe was forced to issue a clarification, but the damage was done. Trust is a non-renewable resource, and Adobe was burning it by the gallon. The IPO and the valuation rollercoaster. Riding the wave of goodwill and armed with Adobe's cash, Figma prepared for the inevitable, the initial public offering. In mid-2025, the company finally pulled the trigger. The anticipation was electric. In a market starved for high-growth tech stocks, Figma was the golden child. They were profitable, they were growing, and they had a narrative that investors loved. The David that not only survived Goliath, but took his lunch money. When the stock hit the market, the reaction was euphoric. The valuation soared, briefly touching $68 billion. It was a vindication of Dylan Field's vision and a repudiation of the old guard. But the markets are fickle. The initial pop was driven by hype, and as the dust settled, the reality of the public markets set in. The stock cooled significantly, dropping by nearly 50% from its euphoric highs. Critics pointed to this drop as a sign of failure. They argued that the IPO was overhyped. But this analysis misses the forest for the trees. The drop wasn't a sign of a broken company. It was a correction of an overheated market. Even at the corrected valuation, Figma remains a juggernaut. They are trading at multiples that Adobe can only dream of. They have successfully transitioned from a startup to a major public institution, and they did it without selling their soul to a conglomerate. The comparison with Adobe is stark. Adobe's stock has stagnated, trapped in the uncertainty of the AI revolution and the legal battles over its business practices. Figma, meanwhile, represents the new guard. They are native to the web, native to collaboration, and now native to the public markets. The algorithm of greed. The story of Adobe and Figma is more than a business rivalry. It is a diagnostic test for the health of the technology industry. For 2 decades, the playbook was static. Big tech companies didn't need to innovate because they could simply acquire. They created kill zones around their core products where no investor would fund a startup because they knew the incumbent would crush or buy them. The Adobe Figma blocked merger shattered that assumption. It signaled to every venture capitalist and founder that the exit strategy of selling to the giant is no longer guaranteed. This forces a return to the basics of capitalism. You actually have to build a business that can stand on its own. Adobe's billion-dollar penalty is a lesson in the cost of rent-seeking. Rent-seeking is an economic concept where an entity seeks to increase its wealth without creating any benefits for society. Charging hidden cancellation fees is rent-seeking. Buying a competitor to shut them down is rent-seeking. It generates profit, but it doesn't generate value. Adobe spent years optimizing their ability to extract rent from creatives. They built fences instead of bridges. Figma, conversely, built a platform that generated value by making teams faster. When the two collisions occurred, the regulatory system finally worked as intended. It prevented the rent seeker from consuming the value creator. The infinite game. So where does this leave us? We have a wounded giant in Adobe, still powerful, still profitable, but legally and reputationally besieged. We have a newly public challenger in Figma, armed with cash and credibility, but facing the brutal quarterly expectations of Wall Street. And we have the users, the millions of designers and developers who just want tools that work without trapping them in financial snares. The lesson here is that the moat is a lie. Adobe thought their file formats and industry dominance constituted an unassailable moat. They believed they could treat their customers as captives because the switching costs were too high. But technology is fluid. The browser eroded the moat, collaborative work drained the moat. And when they tried to buy a new moat, the government filled it with concrete. There is a profound irony that the money Adobe extracted from users through cancellation fees and high subscription costs ended up in the bank account of the one company threatening their dominance. In a way, every designer who paid an unfair fee to Adobe contributed to the funding of Figma. It is a beautiful, poetic justice. But we must not be naive. Figma is now a public company. They have shareholders to please. The pressure to show growth will eventually lead them to the same crossroads Adobe faced years ago. Will they squeeze their users to juice the numbers? Will they become the villain they sought to destroy? The history of capitalism suggests that today's revolutionary is tomorrow's tyrant. For now, however, we can celebrate a rare victory for competition. The market is open, the tools are getting better, and somewhere in a garage or a dorm room, a new founder is looking at Figma and thinking, I can build something better than that. And because the acquisition was blocked, they might actually get the chance to try. This entire saga forces us to ask a difficult question about the software we rely on. When you pay your subscription this month, ask yourself, are you paying for the value you receive, or are you paying a tax to a company that considers you a prisoner? The difference is subtle, but as Adobe found out to the tune of $1 billion, the market eventually learns to tell the difference. Drop your thoughts below. Does Figma's victory signal a new golden age of software, or will they eventually become just another Adobe? And if you want to see how another tech darling is navigating the treacherous waters of hype and reality, you need to understand the chaotic rise of the nothing phone. But that is a story for another time.